Fed cuts rates amid warning signs, why Americans should be paying attention. 1. A rate cut framed as risk management. The Federal Reserve reduced its benchmark interest rate by 25 basis points, bringing it to 4.00 to 4.25%. Market reactions were mixed. While rate cuts are typically seen as stimulative for borrowing and investment, Chair Jerome Powell characterized this move as a risk management cut, signaling concern, not confidence. The move did little to stabilize equities, with the S&P 500 sliding initially before partially rebounding. The Fed's messaging emphasized caution rather than optimism, a subtle red flag in central bank language. Footnote: the Fed's rate cut wasn't meant to fuel growth, it was an attempt to prevent a breakdown. 2. Softening labor market and immigration pressure. Powell acknowledged notable weakness in the labor market, stating, "I can no longer say that the labor market is very solid." The softness is attributed partly to ongoing layoffs in key sectors and a shortage of low-wage workers in agriculture and logistics, exacerbated by immigration crackdowns. Fewer workers mean higher labor costs, which translate into higher food and goods prices, a direct inflationary driver. Meanwhile, despite easing rates, companies are not expected to rehire laid-off workers en masse. Automation is filling the gap, not people. Footnote: a weakening labor market combined with rising costs sets the stage for stagflation. 3. Artificial intelligence drives layoffs, not hiring. Powell specifically pointed to artificial intelligence as a major disruptor. Businesses are turning to AI and automation to cut costs amid economic uncertainty. Layoffs in tech, finance, and even service industries are no longer isolated events but part of a structural shift. The Fed does not expect recent rate cuts to reverse this trend. Companies are not incentivized to rehire employees they've replaced with algorithms and machines. Footnote: AI is not just a tech trend, it's an accelerating job eliminator during economic tightening. 4. Markets need more than a 25-point nudge. Strategists and investors expressed skepticism about the effectiveness of the modest 25 basis point cut. Many argue that cuts of 50 to 75 basis points may be necessary to meaningfully impact credit, housing, and employment. The Fed's cautious move is seen as too little to shift macroeconomic momentum, especially given ongoing inflationary pressures. The yield curve responded modestly, and housing remains under strain. Footnote: a quarter-point cut is symbolic, not strategic, in an economy demanding bold intervention. 5. Wages flat, prices rising, the middle class squeeze. With inflation expected to persist into 2026 and wages remaining stagnant, real purchasing power is eroding. Households face rising costs in essentials, food, housing, transportation, with limited income growth to match. Powell acknowledged this risk. If inflation accelerates while employment declines or stagnates, it creates a dual squeeze: people have less money and everything costs more. This scenario is economically and politically volatile. Footnote: when inflation rises faster than wages, the middle class foots the bill, again. 6. Market volatility reflects deeper uncertainty. Markets responded erratically to Powell's remarks, dipping during the press conference and bouncing back as investors recalibrated. While stocks remain at or near all-time highs, this creates fragility. A heavily valued market layered over a shaky labor market and persistent inflation suggests an unsustainable disconnect. Analysts caution that future rate cuts may signal deeper structural weakness, not recovery. Footnote: markets at all-time highs in a soft economy are less a triumph, more a warning shot. 7. Recession risks now loom larger. Though Powell did not use the term recession, the indicators he referenced, labor softness, automation displacement, inflation risk, paint a concerning picture. Should layoffs increase while consumer demand weakens, a recession could follow. The Fed's own forecast includes additional rate cuts in 2025 and elevated inflation into 2026. That's not a recipe for growth, it's a slow admission of trouble ahead. Footnote: the Fed's projection of further cuts and lasting inflation signals a recession may already be forming.